Have you ever asked yourself how the taxes on your property are calculated? There are some things that you will need to understand if you want to know how to calculate your annual property tax rate. Regardless of where you live, there are some formalities that you will need to be aware of. So stay tuned. Hello, my name is Medranda, a real estate salesperson with Ian Alexander Real Estate Team at eXp Realty in Long Island, New York. In today's video, I just want to introduce you to understand how your property taxes are calculated in Long Island. And just a disclaimer, this video is for information purposes only. If you have any questions or concerns about how your taxes are calculated, please consult a tax professional or your local tax assessor for the county that you live in or you move into. In Long Island, the two main counties to consider are Nassau County and Suffolk County. In Nassau County, you can expect to pay an average of 2.24% of your home assessed fair market value. Suffolk County is a fraction more expensive, clocking in at an average of 2.3% of the assessed fair market value. Assessed value is typically a percentage of the property's fair market value, which is then used for tax purposes. Local municipalities, such as cities, counties, and school districts, might levy a property tax on properties within the boundaries of that municipality. Property tax is an ad valorem tax, which is Latin for according to value. The assessed value of a property is based on a number of factors, but it is not an official appraiser like the one you might get when you are buying or selling a home. How assessed value works? The tax assessor of your local municipality is responsible for calculating the assessed value of properties within that municipality. The assessor's office is also responsible for the review and approval of all real property tax exemptions, which includes the START program, which is the basic and enhanced, veterans, senior citizens, volunteer firefighters and ambulance workers, disability, religious and not-for-profit, home improvements, business, first-time home buyers of a newly constructed home, and agricultural. All applications and/or renewals for real estate property tax exemptions must be filed with the assessor's office no later than March 1st of each year. However, in general, assessors start by calculating the fair market value of your home. They will look at comparable properties in the area, along with the specific attributes of the home, including the square footage and the features of the home. In some cases, assessors might even be required to visit the property personally for an inspection. Once an assessor calculates the market value of your property, the municipality will calculate how much you owe in property taxes based on a residential assessment ratio and mileage rate. In some cases, your tax assessor might reduce your assessed value based on exemptions that you might qualify for. The residential assessment ratio is a percentage that states or municipalities apply to a home's market value before the tax rate is applied. If your home's value is $500,000 and the residential assessment ratio is 40%, your home's assessed value is $200,000. From there, your municipality will apply a tax rate that's sometimes called a mileage rate. The mileage rate is used to describe how many dollars per $1,000 are owed in taxes. 10 mils, for example, means that you are liable for $10 in every 1,000 of assessed value. For example, with an assessed value of $200,000 or $15 per 1,000 or 1.5%, your property taxes for the year will be $3,000. That is $200,000 times 1.5%. What assessed value means for you? The assessed value of your home is important because it determines how much you owe in property taxes every year. As the value of your home increases over the time, typically is updated annually, your property tax bill is likely to raise too. If you believe that the assessed value of your property is incorrect, you can dispute it and request a reassessment. Remember though, that in many cases, you don't have to pay your property taxes directly. Instead, your loan services estimates how much you will owe and divides that estimate into monthly payments. The servicer then taxes monthly payments into principal and interest payments. When the property taxes are due, the servicer will pay them on your behalf. If the estimate was correct, nothing changes. But if the assessed value increased and you owe more property taxes than what you paid, you might need to make a lump sum payment into your escrow account to satisfy the amount you owe. On the flip side, if the lender overestimates what you owe, you might receive an extra refund. In some cases, you might be able to pay property taxes on your own and without contributing money to an escrow account. Now, remember this. The assessed value of a property is the value that local municipality uses to calculate property taxes. The methods of calculating can vary depending on where you live, but many of the core factors remain the same. Unlike fair market value, the assessed value is not used during the buying or selling process of a home. Understanding how assessed value works can help you ensure that you are paying enough property taxes every year. I hope this video provided a good information on understanding how your property tax is calculated. I am Darling Medranda with eXp Realty. If you like this video, please share it. This will help me to tell Google to show it to more people that might be looking for the same information. And don't forget to subscribe. You can also visit the description area below this video to download your buyers and sellers free guide, as well as my contact information. And remember, whether you are buying a home or selling a home, it all starts with a dream. Let's dream together. Thank you, and I will see you soon.